Hello and welcome to the next of our revision course lectures. We're still looking at question 2 here. We're looking at key parts that come up quite often in question 2 but don't generally appear much on other parts of the paper. And the next one I want to look at is IAS 12, which is income tax. So this is, as I said, a part that comes up very often in question 2. So what we'll see is that there's a tax charge in the income statement, and it will include the movement on our deferred tax balance on our statement of financial position, and it will include the movement on income tax in our statement of financial position. So both of those movements will be combined into the tax charge on our income statement. So those are two things that we would have to deal with in question 2. Usually there'll be a note that gives us information about both the income tax and deferred tax. Remember that deferred tax reflects timing differences. So that's timing differences between the tax rules in a jurisdiction and IFRS rules. It seeks to stabilise our tax charge. So rather than having a lot less tax charge one year and then lots of tax charge the next year, deferred tax seeks to smooth that out by regulating the differences between IFRS and local tax rules. So how do we deal with it? Well, the deferred tax balance that we'll have on our statement of financial position can be calculated like this. The difference between the carrying value of our assets and the tax base. Now the carrying value we might have to calculate, the tax base we'll be given, or we might be given both. So we compare the carrying value of our assets and the tax base. If there's a difference between the two, to get our balance on deferred tax, we multiply that difference by the tax rate given in the question. So that's how we get the deferred tax balance. So as we said, the tax charge on the income statement will include the movement on that deferred tax balance. So there'll be a balance brought forward from last year. There'll be the balance that we calculate that's required for this year, the difference between the carrying value and the tax base times the tax rate. And if there's a difference between last year's deferred tax balance and the one required this year, then that movement will be posted to the income statement. So how do we interpret this? Well, we'll have to have a comparison between that carrying value of our assets and the tax base. If our financial statements show more asset, so we've got a higher value for our carrying value of our assets compared to the tax base, then that will create a deferred tax liability, a credit balance on our statement of financial position. If it showed less asset on our financial statements, well then that would create a deferred tax asset. Now generally speaking, in our exam it will be a deferred tax liability. So we'll compare the carrying value of our assets and the tax base given to us in the question, and the carrying value of the assets will be greater than the tax base, creating a deferred tax liability. But it could be the other way around, so you need to be careful as to whether it's a deferred tax asset or a deferred tax liability. Carrying value higher than the tax base, that's a liability. Carrying value lower than the tax base, then that's an asset. How do we deal with the results? Well, remember, we need a movement to increase or decrease our deferred tax balance from last year. That movement goes to the income statement. So debit or credit the income statement to increase or decrease it. So debit or credit the income statement, debit or credit deferred tax. One last thing to note on this, if the movement on deferred tax was created by a revaluation, so if we had a revaluation of our non-current assets, for example, that would mean the carrying value would go up. And if that creates a deferred tax liability, then rather than debiting the income statement, debit the revaluation reserve, credit deferred tax with the movement. So if the movement is created by a revaluation, then the amount of that movement that is created by the revaluation is debited to the revaluation reserve instead of the income statement, credited to deferred tax on the statement of financial position. So do look out for that. You'll see that quite regularly in these question 2s, so you'll get used to those. Let's just show you a simple example. This is quite similar to the type of note that will come up on question 2. So we're told that the current balance on our income tax liability is 340. The current balance on deferred tax is 200 and it's a liability. And the tax rate is 30%. So we would be given a trial balance showing those balances on income tax and deferred tax. And then in the note, we would be told that the provision for income tax required for this year is 900. And the carrying value of our non-current assets is 3,000 with a tax base of 2,000. And we would have to deal with all of that information. How would we do it? Well, what we would do is that our income tax provision, first of all, would be the thing we deal with. And it needs to increase from 340, which is the current balance, to 900 because we're told that the provision required is 900. We would post the movement on that to the income statement. So debit the tax charge in the income statement with 560, the difference between our 340 and 900, and credit the income tax provision to get it up to that 900. So it's currently 340. Credit it with 560 would increase it up to 900. For the deferred tax, well, the carrying value of our non-current assets is 3,000. The tax base we're told is 2,000. Looking at our table, the financial statements show more asset. So that's going to be a deferred tax liability. So the financial statements show more asset. So that's a deferred tax liability. How do we calculate how much it is? Well, remember, it's shown there the difference between the carrying value of the assets and the tax base multiplied by the tax rate. So the difference between the 3,000 and the 2,000 is 1,000 times 30% gives us 300. So what is that 300? That is the deferred tax liability required. The current liability we have is 200. So what do? Well, we post the difference to the income statement. So the movement goes to the income statement by debiting the tax charge with 100 and crediting deferred tax with 100. So that would get our deferred tax liability up from 200 to 300, and the movement on that would go to the income statement. So whether the deferred tax movement is up or down will tell you as to whether it is a debit or a credit to the income statement. In this case, we were increasing it, so debit the income statement, credit the deferred tax liability. So the total charge to the income statement would be the movement on the tax, so that would be 560, plus the movement on the deferred tax of 100. So the total charge would be 660. So that's very similar to the sort of notes you will get in question 2. So make sure you can deal with that, and we'll come across it when we look at an example on a question 2.